welcome again, everyone. Super excited to have you for our Wealth Building Masterclass series. I'm your host, Loomba, and I'm really excited and happy that you're here today because today's conversation is very timely, and honestly, I think it can reshape your thinking, your decisions for the next few years. So the question is multifamily becoming a risk, or the biggest opportunity is right now? That's what we're going to talk about today. Because what we're seeing in the market today is not normal. I mean, that's how I feel, at least from my experience. It's kind of very strange or uncertain, because we are seeing multiple things at the same time, but I'm not sure if it's like kind of repositioning for the market behind the scenes, or we are like stepping into complete downturn, or maybe it's one of the best opportunities to enter the market at this time. So those are the questions that I have in mind. And I was talking to Sid, and I thought maybe we should bring this perspective and share this perspective with everyone. So today I'm very happy to share that I'm joined by my good friend Sid Sharma. Sid is the founder and CEO of Headway Capital, a Houston-based private equity firm with over 500 million asset under management. He started as a Fortune 100 engineer managing projects over $100 million. And today he has helped raise over 150 million in capital and guided hundreds of investors into multifamily real estate. And I think what I like about Sid is his approach. He does not just talk the theory. He's in the market navigating the real deals and real challenges. And he takes really pride in that. I think before we stepped into the webinar, that's what we were talking about. So welcome, Sid. I'm really happy that you're here with me today.
Thanks for having me. You have a great following. I'm honored to be here.
Ah, thanks again. So I think before we get started, let me share my screen. Let's go through a small little disclaimer. This session is strictly for knowledge sharing purposes and should not be considered as a legal, accounting, or investment advice. This session does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. So if you have any questions, any technical questions, any financial investment related questions, please reach out to your CPAs or your investment advisors or your attorneys. So without further ado, let's get started about our topic. If multifamily is a risky business right now or is the biggest opportunity. So Sid, I'm just going to go straight into that because I know there's a lot of noise in the market, with this inflation, interest rates, uncertainty. So a lot of questions come to the mind, whether it's the right time or wrong time. And I think a lot of people are thinking the same thing too. So from your vantage point, what is actually happening in the multifamily market today? And what most investors are understanding or misunderstanding at this point?
Thanks, Vicky. So I'll keep it short. I think there's a great saying, right? When everybody's scared, you should be greedy, and the other way around. Um, the multifamily market or commercial real estate market in general is just not performing the way it was performing back in 2017 and onwards until all the way 2022. We all know the rate spiked, and I don't want to be a broken record here, but what's happening on the ground right now is that we have the most number of assets, apartment complexes that are being under distress, under financial distress, that are not qualified or out of compliance from lenders' perspective. Meaning, at some point, and it's already been happening, those apartment complexes will go to foreclosures. It has been happening since I want to say good part of early 2023. Right. As an operator, we see this as an opportunity because we know a big, large number of big groups. They are on the sidelines and they are evaluating, what to buy, what not to buy, and in which market to touch. And that's purely because their theses have been revolving, meaning some years they are looking for industrial, some other years they're looking for some other asset classes. On the ground, the winner is going to be the ones who are truly champions in operations, who can turn around and a struggling property from operations perspective, and who can also negotiate well with the lender. Meaning, if you are the owner or operator or a GP or general partner or somebody who's running a multifamily investment, you gotta be really good on those two things. But if you're somebody who's trying to buy or trying to invest, I really feel like um, this is a time to really monitor market deeply, because there are a lot of distress assets coming out in the market, and we can obviously talk about what distress means. But this is a window to buy, right? The next I was thinking 2025 will be the last year for the window to buy, but it looks like it's going to go all the way to 2027, maybe 2028, where these distressed assets continue to evolve. I just made an offer today on an asset that was sold for $98,000 per unit. I made a very insulting offer. I don't know if it's going to get accepted or not, but the broker is hopeful. We made it for $55,000 per unit on a 240 unit apartment complex. We did the same. We used the same strategy in 2024, and we acquired two assets post foreclosure, pre foreclosure. I'm sorry. And we, as far as I'm concerned, my firm is concerned, we are focusing on um, right location,
Hmm.
a good price point that we can enter.
Hmm. Yeah, no, thank you for that. And I know one of other teams, they actually are friends too. They got it like around 25 per unit, 25,000 per unit. It's like a really crazy price that they got.
Yeah,
But the only thing was the occupancy was so low, it was like below 40%. But they're gonna just revamp the whole thing and bring it up to the market. But you brought up a really good point earlier. You mentioned distress. We can talk about that. So I wanted to stay with the theme for a moment, and I wanted to ask you what the word distress
what do you
it's
mean?
being
Yes,
used everywhere.
exactly.
What does it mean? And when
Yeah,
people hear that, sometimes it creates a fear in them. And some people feel like, oh, it's an opportunity. And
yeah,
then, like you mentioned from your personal experience, you feel like it's an opportunity and you're getting into distress. And I know a lot of funds are moving into the distress asset too, because I see that all around me in my network. People are just, starting these funds, then just like focus on the distress asset only.
yeah. Before I
What is
answer
it?
that, yeah, to your point, one of the groups that we actually just acquired something last year, December, to a very low price. I personally don't want to share it at the moment right now. I don't want to get my tax to be increased, but it's a really, really low price of something that we think, even if the property is 20% occupied or 10% occupied, it's gonna break even. I'm not gonna lose money on that. So those assets uh, that are in the market. Going back to your question, it's extremely important to know distress. As an
Hmm.
investor, as an LP, you get an email in your inbox or a phone call. Hey, Mr. Bob, I've got a distress asset. Amazing deal. We should be buying it, and it's going to be a slam dunk. Well, if I, as an LP, don't exactly know what distress means, or do I have an expertise, or even the knowledge to differentiate between a good distress or a gimmick distress, right? Is it truly a distress, or is somebody telling me a distress? So if you are an LP, you should really look into two perspectives, or two break it down in two ways. Is this property operationally distressed, or is this property distressed because of the capital structure, right? So operation distress or a capital distress. 9 out of 10 times you will see an asset that is operationally distressed in capital wise distress, right? It's very hard, maybe a unicorn of a deal that you have a capital distress asset, but it's not operational distress. Because if an asset is not operational distress, your lender or your capital will work with you to make it happen. So we are not seeing too many of those kind of deals where an asset or a multifamily apartment complex is only capital distress. We are seeing a capital distress as well as operational distress, and that's where the real mix, the real magic happens, or the real trick happens. Is, are you working with an operator who knows how to fix the operational distress, right? Because if the previous guy couldn't do it, how would you make sure that this person who's operating it is doing it? Meaning, is your example, um, property was distressed, it's very low in value because occupancy is 30% or 40%. right?
Hmm.
Now, three questions you want to ask: who's the operator? Are
Hmm.
they able to turn it around, and how fast they can do it? What location are they doing it? And if there's any third factor that's going in the market that created that kind of distress back for the previous guy, right? So if they can answer those three questions, that is a oversimplified litmus test that I can tell you for your audience is when you're looking at for distress, ask these three questions to yourself, and then from there it's all common sense, right? Yes, there are some technicalities involved. You got to know some financial terms and things of that nature, but as an LP, that's not my job. As a GP, that's my job to explain it to the LPs or to limited partners or to investors that what is a true distress in my view, and an LP can make a decision from there.
I think before we go further, there's a couple questions. Let's answer those first. So, whoever want to know, what about structural and environmental distress? Can you speak to that as well?
Uh, so structured distress, if I'm understanding the question correctly, meaning how the partnership is structured, and that's still a capital structure, right? Because by the time when the lender is trying to take an action, that LPGP structure is gone. Unfortunately, at that point, investors have lost all of their capital. The general partners will probably lose the deal, and the lender is the one who is negotiating the terms with the new buyer. So if you find a deal that is not at that point, then you got to go deep into it, that how this structure is going to either help the deal to get on top or to make it even more difficult. What I've seen in those kind of cases, again, that comes back into the capital distress category. If your partnership allows you to bring more capital on top, right? Sometimes it happens that, hey, the current GP and the LPs are very low on cash. They cannot support the business. They cannot execute the business plan anymore. And they try to go and raise more capital. To me, it's a big no. Unless and until there are solid guarantees. Because what happens is if if a group comes to me and say, we are a general partner and we have 50 investors or 100 investors, but we are short in cash or capital, we want some more capital. You as a new investor would like to come invest. Well, you got to ask what is my position going to be, right? Am I going to get paid first? How much? If you could not perform business plan A, which was your previous business plan, what are the guarantees that you will perform business plan B, and what are the changes that you made, right? And if you are confident that you can do business plan B, will you put your interest below ours? Meaning, will I going to get paid first before anybody else? Unfortunately, lender is still on the dictating terms, right? So if lender is still calling the shots, it's it makes it very risky to to invest in a deal like this. I've got some opportunities where some of the GPs came to us and asked us to raise capital for their deal, and the deal was exactly like that. They didn't have the capital. They believed in the deal. The bases were good, but I couldn't consciously do that because I did not have a control. Because even though I we get all of our returns first, lender is still calling the shot.
Hmm, interesting. And you mentioned lenders are calling the shots or not calling the shots. But in this market, how lenders are doing. I mean, they're struggling too, if you look at it.
Yeah.
I
So
recently
20,
heard about BlackRock. They are like, just like, no more liquidity, not even 20% you can take it out, because everybody is doing that across the board, because lenders are in the same distress situation too. It's not just the deals only.
Absolutely. It's very lender balance sheet specific, right? The bigger the lender is, the more writing off bad debts happening. Meaning, bigger lender, they're just gonna write off their losses on the balance sheet and they're gonna just throw the property back to the servicer, right? And the servicer will either make it or break it, or they will be the one who are selling it. Again, we're going into a little bit of technical terms, but now what lenders are trying to do is they're not willing to work with the operators anymore. They're simply not. They're now we are seeing that lenders are now taking loss on their capital in order to just get out of the deal, right? So instead of losing 100%, like example what you said on BlackRock's, um, they might own, just throwing an example, $10 million on a deal, and the deal today is not even worth $10 million. Remember, this is a debt. The GP and the common equity is all gone, right?
Mm-hmm.
So now you're only talking about the debt part, which is 70%, 75% of the equity of the overall structure. Those assets are not even qualified, not even appraised for that 75%, meaning overall the asset has dropped in the value for about 60% left.
Mm-hmm.
Lender is wanting 75%. Well, lender was saying, okay, well, you know, I'm good. I'm going to write off that 15% or 10%. I'm going to sell it today, whatever the value is today. So that we're seeing that's happening a lot. And I think that's continuing to happen in this 2027 and 2020, 2026 and 2027.
I think maybe a little bit longer too. But let me ask you this. If we go one layer deeper than this, what are the main factors that are driving the market right now? Like, for example, if it's just interest rates, or are we looking at a combination of things, how people are perceiving the market or underwriting the deals, or I think as a whole, how market is being perceived and how people are looking at
Yeah.
deals.
I think the short answer is uncertainty, right? So it's very uncertain. If you're following treasury interest rates, they're going back up. Next week they're coming down. So it's really you cannot predict what the treasury will be next few months or few weeks even. The other thing is, so if you know, so this is the biggest factor. If the treasury, if buyers and seller can predict where the treasury are going, then market will automatically adjust, and you will see a lot more transactions happening, because now buyer will know that, okay, this price I cannot expect this to go down any further, and seller can expect, so those bid ask gap will decrease quite a bit. The other thing I would say is, you know, just the inflation pressure, right? That's a bigger factor, right? We all see what's, our grocery bills are going up, or gasoline bills are going up, and all of those things. But I think that's somewhat of a secondary matter to me versus the uncertainty on the transaction market, right? If that uncertainty goes away, there's a lot more certainty on the economy going back to it, right? There's obviously other environment. I think one of the questions that somebody asked about the environment, I'm assuming what they mean is that, what is the overall economy environment, and this uh,
Mm-hmm.
several situations happening with border control and ICE and inflation and uncertainty on the international market. I think all of that uh, is a downward pressure for sure, but I think majority of those things not going to sustain for too long. So those things will settle down, and that will only help Treasury to pick a stance and go with it, right? So it's the uncertainty is really what driving the market uh, into stagnation, if that makes sense.
I think it's just the whole economic structure, how it's happening. It's kind of a ripple effect. It's just not just the multifamily. Like everybody says, multifamily is recession resistant. Everybody needs a place to live, but not necessarily, right, all the time. So, what question is coming to my mind is, based on whatever you're seeing right now, it's not even just in US, it's a global economy. Basically, that's what I'm saying, is kind of a ripple effect. So, where do you think, where we are in the cycle?
Yeah.
That's the biggest question I would think at this hour, because we all know about the market cycles. We talk about it, okay, buy low, sell higher,
Yeah.
but it always happens opposite, right? So now it's very hard to time the market at this time. And looking at economically, structurally, environmentally, whatever way you wanted to put it, if you put all your hats on together, I take a holistic view. So as an investor, myself too, I wanted to know, where at what point I am in the market cycle. Is it a good time for me to get in, or should I wait a little bit longer?
Correct. No, great question. I guess I can definitely try to answer, but it's definitely just my opinion, right? The way I look at it is really I try to divide it into three. big areas of if this is a true market that I want to invest or not, particularly in stock market or in any other investment, including real estate. So let's just talk about real estate. Real estate cycle, it's a organic cycle, meaning you invest in a market, population is growing, builder comes in, they overbuilt, and then now your rent's declining, and that's the time you want to get out of the market, right? That's an organic cycle, meaning it's a no factor. Everything else in the economy stays the same. It's constant. It's a little bit of change here and there. Nothing crazy going on. Organically, I think we are in a end of a cycle, meaning all major markets, there's no development happening, right? Especially in Texas, all development happening in Austin is completely halted. There's no development in Houston. There's hardly any development going on in Dallas. And Houston, some other markets, San Antonio, they still have the lowest construction pipeline happening. So organic cycle, in my opinion, is a great cycle to be in, meaning that that cycle is still now bottoming out and it's going to go back up. Those rents, and because the construction is dropped, the rent's going to go up, right? The second big factor that I think about is really the national economy or national/international economy. And that really tells you what will be the bigger impact. Like you said, multifamily is awesome real estate. People have to live somewhere. But here's the thing. If your inflation is forcing your expenses to go up, you're going to increase the rents. But if your payers are not being qualified, they're going to skip on you more. They're going to owe you rent more, and your overall income will drop. Right now, that argument which most people make is that people have to live somewhere, and I'm still a big believer. The advantage with multifamily is that you still have a lot of tenants to collect from, unlike retail, unlike other non-essential services where few of the tenants are gone and you're out, right? So the second factor on the economy side, international and local, that impacts you. Now, depending on what's your view, you can make a decision from there. I mean, hardly my view is it's in a transition. It's going to get better. Things will not be the same as it was before, but in long run, it will be okay, right? Or even in short term, right? It'll be okay. And third is a sub-market. You have some markets. I mean, Texas is one of those markets where national or internationally you can do worse, but because oil is awesome or
Mhm.
WTI pricing are awesome or crude oil pricing are awesome, your Texas market will still flourish. So you definitely want to see the organic cycle of the real estate or of the investment. You want to consider the national or international, and then you want to look at a submarket, right? Your submarket and your organic one, you should not have any confusion knowing that. Internationally, it's your perspective, really.
Great. So when you're talking about the international market, I think somebody had a question regarding the Canadian market. And here, let me scroll back up.
Mhm.
So Sumit wants to know, is this perspective on multifamily about US market or Canadian market? If Canadian, then which provinces, if you have
Yeah,
any
great
idea?
question. Honestly, it's purely on US market. I mean, I monitor US market data more,
Mhm.
um, but I can almost predict that this is very much translatable to Canadian market as well. Builders are not getting a good um, worthy loan products to build projects, and I think that's the same in Canadian market as well.
Okay, perfect. So earlier, I think you were talking about the interest rates and the treasuries and how you cannot really predict, but the which way market's going to perform. That's going to dictate somewhat the interest rates. But I would like you to share with us your perspective of how you're seeing the correlation between the interest rates and as well as the inflation, because right now it's kind of I would say strange or very uncertain situation. The inflation is kind of all-time high. At the same time, interest rate, we do not know which way is kind of going. So I'm
Yeah.
not even sure. Everybody wants to say interest rates to come down, but how about inflation? How are you going to control that? So but and not trying to take the subject somewhere else, but I think this all has an impact on the market where we stand today. So it's very important for us to understand that as well.
Yeah. I think the job federal government have just one mandate is to control the job, meaning increase the job and decrease inflation, right? If any of one of those factors are imbalanced, you will see the interest rate being unpredictable, right? To answer your question, I look at the jobs data closely, and the way they have been reporting for the last few years is kind of crazy. But the job data tells me uh, very clearly what's happening in that local market or nationwide as well. So to answer your question, I think if you really want to predict how how this interest rate will behave, you want to look at the job market, job data, and you want to look at the inflation data.
Somebody's looking at the market today. How do they separate what is the real risk versus the noise or the perception? Because there's so much chaos. And sometimes, people are saying, oh, Texas market is good, Houston is good. And then I think it's a slam dunk, some people say. So I wanted to hear your perspectives because you're sitting in that market and how you're perceiving it.
Yeah. Look, I can tell you I spend 80% of my time these days on improving operations. That includes, personnel, people, and your company culture, and just overall, really nailing down every aspect of operations, incomes and expenses and things of nature. Um, if I really have to put this number one risk is going to be your operational risk because now it's getting harder to manage expenses and generate income. Um, and the, to me that's a bigger one, right? The
It is. Mhm.
who you're working with as an operator is extremely important. The number two is definitely pay attention to a capital structure, right? Do not touch a deal or do not invest in a deal that's over leveraged, meaning not more than 75, maybe 70 is better.
Mhm.
And then more importantly, you know, if you're an investor looking to invest now, you want to see what is the basis going in, meaning what is the price that you're buying the property today, and can
Mhm.
it perform on today's income and today's expense? Um, I think if you can understand those three things, that is a first step to manage risk, right? Obviously, um, we run a risk model. I'm happy to share with somebody. It's our proprietary model, but I'm happy to share the first phase of the risk model. And the risk model is like seven different spreadsheets that we create, and it calculates all the way from it predicts, not predicts, it basically analyzes all the data from rent growth to if this property will ever be in a fire zone or a flood zone, right? It's pretty extensive. Uh, as an operator, that's my job to do it. As an LP, you may not have the opportunity or means to go do all that research, but I think um, knowing the location, knowing the operator, um, the business plan that includes what price that you're going in, and can that price still produce the cash flow for the current income and current expenses is extremely important. So basic, what I'm trying to say is go down to basics
That's true. Mhm.
and figure out, if this income or expense can truly support what you're investing in.
So I think you brought up a good point. You said go back to the basics. So let's go back to the basics. And then you're talking about the operational inefficiencies. So I wanted to understand from you, actually from your experience, and I can share mine as well, how did we get here, first of all?
Yeah.
Right? It's not just like we can say, okay, this is a good market. Obviously, it's a good market for the people with the deeper pockets, right? And for the operators, like, day-to-day operators who got into so many deals in the past 2, 3 years. So all these operational inefficiencies. How did that happen? What brought them here? Because
Yeah,
it's a learning experience, I would say, at this time. And everybody should pause at this time, not rush to anything, because this is a moment of pause and reflect on where we are, how did we get here, what happened exactly.
yeah,
And I think in my technology world, I will call it is that a business intelligence. And take that business intelligence and run with it with your next move.
correct,
So
correct.
let's talk about the operational now. How did we get
No,
here?
you're asking a really good question. I don't think I can say it on the camera, but the reality is that, dumb money chase dumb deals, and that happened way too fast. Um, uh, that's the best way I can explain. You and I both have seen operators out there in the last 4, 5, 7 years. Um, their business model was to raise capital and hand over the whole project to a third-party management firm. And that third-party management company, in my opinion, are not fairly compensated, right? The way they are get compensated on the performance on property, they are required to go buy as many properties as they can, right? And that is a recipe of disaster. So when I started, I hired the third-party management company, and I kid you not, on my second month, I had to fire them because I could see that this is not going to work anymore. Um, but I didn't fire them knowing what I know today. I just found a financial misappropriation. I couldn't take it, and I just terminated them. Right. And at that point, I had to go take a sabbatical from my company, come and manage the property. It was a different story altogether. So I
Mhm.
think too much capital. Um, Everybody paid too much. The interest rate was just too low for too long. That to me, it was really something to be coming up. But then also on top of it, back in 2021 and 2022, when people were going into variable rate, uh, banks and lenders were requiring to buy the interest rate, but they were not enforcing enough for investment to make sense. Meaning, not only people were paying too much for investment deals, but they were also not buying the insurance on those interest rate for long enough to be able to protect the investment. Lender didn't know, or lender knew and they didn't do anything. And you and I both know some of those insurances, in technical term, we call it rate cap. Those rate cap was $25,000 to purchase.
Mhm.
Year or 12 months, 1 to 2 years later, that same rate cap for $25,000, we sold it for $2.5 million. Right.
Mhm.
So that uncertainty in the market, artificial, um,
Inflation. Yeah.
controlling of those interest rates, that also made it worse. But if I really, I know some good operators. They did everything what they could do. They executed the business plan, but they just couldn't resist with the interest rate. Right? They couldn't just operate the interest rate that they had, and unfortunately, they lost the deal.
Wow. So I think was that it only just because they got in at the wrong time with the wrong interest rate and they
Yeah, they
couldn't
they
do
they
it
were,
because I think the question that comes to my mind is, all these operators, I know you said you cannot say it on the camera, but I think sometimes it's okay to say certain things.
yeah,
All these operators, they get in, everybody is just like, they think, oh, I am in this because I want to make money, right?
all
And
right,
sometimes, the key thing is forgotten that we are the steward of money or the
correct,
capital. It's
correct.
not you're here to just make money, you're the stewards of the capital, and then you have a fiduciary responsibility towards your investors. And
Yeah,
then the capital protection is the key.
yeah, yeah.
That
No, I mean,
should
look, you're
come.
right. You're absolutely right. I think some of the operators were just salespeople. They came in and saw an opportunity, and they say, "Well, we can raise a bunch of this capital. I'll make my money first," and they didn't really care afterwards. And we've seen those examples over and over again. And majority of them. almost all of them are not in business anymore, right? Because their properties are gone, their track record is no more there to support. But to answer the question, yes, there's you know uh, those operators who are purely salespeople. Um, they rally a bunch of investors to raise capital and purchase deals and couldn't perform.
Hmm. But the question comes, I'm thinking from a LP perspective, even from the people who are looking to co-GP with the other sponsors out there. And obviously they wanted to make money, but the question comes, how do we differentiate between the good and bad? You know?
Yeah, no, absolutely. We had a deal. I personally had a deal that right after COVID, it was a deal in an area there was a lot of restaurants. People lost their jobs, occupancy went down, and then there was a homeless situation happen with the property. We ended up writing check on from our own pocket. Um, so I think it's very I mean, you're absolutely right. I think it's purely based on on your as an LP. um, you got to stay engaged, right? You got to stay engaged even in a good market or a bad market to know which of those operators survived. You know, it's unfortunately it's not a short-term solution, right? As an investor, you got to stay in the market. You know, if there was an investor who was listening to you 5 years ago, ideally, if they're true real investors, real estate investors, they should be listening to you today as well, right?
Mm-hmm.
And that's how they should know. That's how they will find out who are the good operators and the bad operators. Now, there is no guarantee, right? A best operator from last year is also going to be a good operator today.
Could be, yeah.
Is unfortunately it's not the case. So it's a hard question, but it's an easy question, but a hard solution. The hard solution is you got to stay engaged in the market. You got to keep your fingers on the pulse on what's going on in the market, in who's surviving, who's not, who's good, who's bad, those kind of things, right? So, and then ask for referrals, right? Ask for referrals that hey, can you share one of your good investors or share one of the investors that was not so happy, right? Can you share both, right? And hopefully, you know, mm, they can make their own decision. I mean, the investor who's not so happy, they might say, hey, look, don't mess with them because they did X, Y, Z. Or they might say, look, they got to a point and they did everything they could. Um, we didn't see the results that we wanted to see, but the operator and the operating partners, they really did what they could all the way to save the deal.
Yeah, and I think I kind of like that idea, or I kind of agree with you because I just feel like if you are a good operator, no matter what market cycle are you in, or how your operation is, or whatever you're trying to do, you're gonna succeed because you know when to pivot, what to do, because you have a plan and you have the resources. But and then you can turn a bad deal into a good deal. I think that's what people talk about. If it's a good operator, they can turn the bad deal into a good deal. And that's where it comes, that saying, that you bet on a jockey, not the horse.
Right.
And then the jockey can make the horse run. And then I think that's what happens. And this is a litmus test, like you said, in these kind of markets. And I think we do have a question from Ronald. He wants to know if we can talk about the different markets, if you have some insight into it at this time, what markets are more lucrative, where people are like levitating more
Yeah.
towards, because I'm in California, I see that, San Francisco is coming back up. So the next market next to San Francisco is Oakland. People are talking about Oakland big time because a lot of our sponsors in my area, they're reaching out to me, hey, we are looking to invest in Oakland. That seems like a very viable option at this time. So I would like to hear your perspective, like, on the US markets. I think he wants to know about the New York State or
Yeah.
New Jersey, maybe.
Yeah, I don't have too much expertise on the New York City in general. Again, that goes back on your sub-market knowledge. But there's one thing that I can tell as a litmus test: no matter which market you go, even if you like the market, you ask for the data from your operator that what is the data that you think this market will survive? And if that's true, then how long will that be? Meaning, are you okay as an investor to go into an uprising market for 5 years, but the market uprise was only for 3 years? So
Mhm.
even though you went to the right market, but you're stuck, right? So going to the right market and time it is extremely important, right? Um, the in my experience right now, I think Sunbelt um, is still a safe haven comparatively for real estate. There's definitely some outliers. I'm hearing quite a bit about Chicago and Atlanta, in California, and some part in the West Coast as well, East Coast as well. Um, but we all know Atlanta struggled for a very long time, right? So
Mhm.
is it because if it's a boom or bust, or is it truly economic activity going on, right? So you want to know, you want to find out what's the job growth, population growth in that area, obviously your basic terms on the rent growth and things of that nature, but you really want to figure out why, if there's a population growth, why is that, right? Is it the population growth is because there's an incentive, right? Back in days, we all know Delaware had an incentive on some, I think it was a long time ago, and there was a lot of population growth there, right? And after that, it's we never um, definitely, I think the Sunbelt market, I'm I don't have the data, but I'm hearing quite a bit about Atlanta in Chicago for the first time. Both those are outliers, right? I don't know much about California. I have not seen the data on California just yet, but uh, after your comment, Vicky, I'm definitely going to look. Sunbelt is a market that we all been seeing, right? Sunbelt, or even some markets on Midwest, um, Tennessee and Nashville and those kind of areas are also experiencing huge rent growth. Um, but again, you want to see what if you want to go into those markets, how are you timing it yourself?
That's true. And I think you're so right about that. It's not just the market overall and whatever news we are hearing, that's like across the board. It's not applicable everywhere, because the some markets or in your local areas, you might be seeing something different with the overall picture that's been, spitted out on you by the media or whatever. So that's the reason it's very important to look into the markets or some markets or the sub regions even, to figure out what's going on, if it's a viable option or no. And I think Ronald wants to know in a follow-up, what will be the impact on the other markets from the pressure on New York market? Because there is always, right, something going on. If
Yeah,
one
yeah.
market is doing this and the other is doing that. So do you have an insight on that?
I'm against rent control, uh,
Hmm.
but
I
that's my
like you
that
said that because I'm in
yeah.
California. I don't like it either.
Yeah, and this could be my short-sightedness because I don't run the government, right? But I run a business, right? So if my rents are controlled, then my expenses should be controlled as well, right? And if it's not the case, then it's an unfair market. It's that market never going to survive. Um, Now I know that there's some of the markets that produce the controlling rents, but they're also giving you a break in your taxes and in your some government utilities and all those cases. Um, that's my perspective. So I think if a rent control is unaccounted in those market, um, I think Ronald, you're asking for New York. You wanna stay away from that market unless something else turns out from a policy perspective, right? Um, if you're looking into Scottsdale, Phoenix, Florida area, I think Phoenix, we own some property in Phoenix. I think Phoenix is still a couple of years behind from true recovery. I think there's some downward pressure on the rents is kind of alleviating depending on which submarket you're in or how close are you with the new supply or new construction. Um, Florida is, I think it's going to be is going to the market for long haul. The only challenge that I've seen consistently is those insurance costs, right? Especially if you're close to water, your insurance is going to be extremely high. And that one factor you cannot control, right? We've seen last 2021 and onwards, everybody experienced the insurance costs increase by 400%. It's now coming down, but those high insurance expenses were just impossible to manage, right? So those that was one of the factors. So that's my take on New York and Florida in general, depending on where you are. If you're um, Jacksonville, Tampa, I think those are the market that are expanding. Orlando, there's a lot of investors, there's a lot of capital there. So I think that ship has gone because the price is already extremely high.
Yeah, but I think Florida too, because my current deal that we closed, that was in Florida. And I think supply, we are seeing less and less from the new build
Yeah.
perspective. And we think, 3 to 5 years down the road, it's going to be a different market. And that's going to give us a good exit at that point because the demand is going to get higher because supply is coming to kind of
Yeah.
nil, if we compare it with the past couple years.
Yeah.
So
Generally speaking, for sure, Florida is a great market. It just um, depends on where you are logistically located, geographically located there.
mhm. Yeah, I think it's about time. I think we should shift into the opportunity. That's what everybody wants to hear. I guess we've been talking about the distress and the wrong things what's happening in the market. So, and I
Yeah.
want to know that too, like we talk about the markets, like, what markets are good or what markets we are seeing some upward trend. And also I wanted to know the asset type. And I wanted to plug this in here because last year I had a conference just go beyond multifamily because multifamily is not the ultimate. There's multiple other asset classes as well, right? So
Yeah.
what asset classes are standing out in this market? And my portfolio is
At the
pretty
moment, yeah.
diverse. And also the other thing I wanted to add that is to the deal structure. That's very important. So how you are structuring the deal, I know you are mainly in multifamily, you're going to speak to that. So how you are structuring the deals, that's like makes the deal much more stronger compared to the previous years.
Yes. So let me answer you the first one. So, what other asset types are flourishing, right? So I kind of say it in a little bit of a funny way. There's always a Bitcoin factor in real estate, meaning within real estate asset classes, you want to identify which are the ones that are non-sexy, essential services, or it comes under essential service, and it's a very hard barrier to entry, right? So you want to categorize those asset classes, and they want to categorize everybody else. Like for example, I've seen data on AI digital warehouses, meaning data centers, right? And
Mhm.
they're, to me right now, it's still a Bitcoin of real estate, meaning the data has
It
not been
is.
proven out. And
Mhm.
there are a lot of states who are now applying controls on how many data centers you can really make, right? Virginia is one of them as a state. They overbuilt it, and now they're um, Nevada, Phoenix, some of those markets, they're now applying constraint on how many you can make. Not only that, they're actually applying constraint on how much power they can use from the city, right? So definitely want to try to stay away from, try to control your investment in those areas as much as you can, unless you really know what you're doing. I personally don't. The data that I've seen so far is not really encouraging at the moment. And the one that you are really trying to touch is the boring, old, non-sexy asset classes that going to be survive even if you have, God forbid, a black swan event like COVID again, right? I personally try to stick with that. It's less paying, sure, or we're not going to have a slam dunk of 10x or 20x, but if I can live at 2x, I'm happy, right? And those areas for me, what we're looking at is um, asset classes that are not being haunted by big corporate and BlackRock groups type buyers, because whenever they come in, your price go up and it's no more a deal, right? So we,
Mhm.
other than multifamily apartment complexes, we are also we now partnered with a group that we create fund for loaning money as a lender to small projects like houses and fix and flips. That's never going to end because you have majority of the country, those houses need renovation. The second thing that we are doing right now is medical commercial buildings, more like specialty clinics and specialty hospitals. So if you ever been to a GI clinic or a cardiology or a orthopedic, those groups, they're boring businesses. They're not going to go anywhere. Their tenants are quality tenants, and the turnover is not as much, right? So this is a new asset class that we personally, I've been doing some research on that. We've tried doing some car washes in past, and it didn't really perform the way I wanted I wanted to see. And I did my
What
investment
actually happened?
first before I brought my investor. Initially,
Mhm,
it was awesome, and not anymore, and we're not doing it anymore. Um,
mhm,
Medical, in my opinion, we've been investing into those medical buildings and medical commercial real estate for last few years, and it's slow and steady. You can predict exactly what's going to happen in the next 2 3 years. So that's what we're touching personally.
and what has changed in your strategy or how you're structuring the deals differently than before? I think that's what I was trying to ask you earlier.
Yeah, I think the so if you're pointing towards how are we doing on the debt side, we definitely try to stay conservative on the leverage, right?
Hmm.
Um, and if there's a deal that you have to go for a bridge loan of some kind, make sure you have enough reserve to buy the insurance on the interest rate if it's a floating interest rate. So I'm not buying a deal if I don't have reserve for 3 years minimum, maybe 5 years of interest rate that I can buy. It's a pretty high reserve, right? Meaning now you have more reserves, less leverage, and with all of that scenario, your deal still have to cash flow, right? So it all boils down to you got to go find deals that you have lower basis in the
Hmm.
decent location in a decent economy or submarket. So that's number one. So definitely looking for lower leverage, fixed rate if possible. If there's a scenario that you have to go get a bridge debt, your operator's business plan has to be foolproof, and at the same time, you have to have enough leverage, enough reserves to make sure that if after 3 4 5 years, if things goes down, there is you have enough reserve to cover it up, right?
Correct. Mhm.
Um, from the equity side of things, nothing much changed there except we as firm personally working more with fund managers, and that helps better communication, double checks, triple checks, in in cases like this where um, fund managers can also ask and do way better due diligence than a regular LP can do, right? So all of the things that you and I just talked about, if I was an LP and if it's my first, second, third investment, I would be lost, right? Like, what are you guys talking about?
I
There's
know it's way too
too
much
much, right?
information.
So that is why
Yeah.
the fund manager is so critical, because say if I'm a fund manager for you, right, and if he
Mhm.
can speak the language, I can understand the risk, I can ask the right questions to you and vice versa, right? And then I can go back to my investors as a fiduciary saying, hey, this is what I did as a due diligence. This is what I checked on this person with this operator, and this is why I think I want to invest with XYZ operator.
Thanks. And I think somebody wants to know the best lenders, top 10. Anybody comes to your mind?
Yeah.
Good
Uh,
promotion for the lenders here.
Yeah, so Fannie Freddie are the ones who are the end servicer. Um, Definitely try to stay. I can give you the good ones where servicers who are servicing for Fannie and Freddie, you definitely see CBRE. Arbor in some cases are super good, but in some cases I've heard some mixed reviews. Um, Newmark, Northmark, they're all good servicers. We never had any problem with any of our lenders. In fact, we are some of our lenders' favorite ones. Um, But I know some of the ones that you want to stay away from is the lenders who just born yesterday and they have a bunch of capital to deploy and they own their own deals as well, meaning they're lenders to own, right? And those are the lenders that you want to stay careful because they will find a way to get you um, and won't be willing to work with you if you're going through a tough time.
You are saying that people are making mistakes, what are the biggest mistakes you are seeing happening in this market, even though people are like super cautious? Like I said, I go talk to somebody, maybe I ask the same question twice just to see, their mental state. Are they giving me the same answer as like a different answer next time,
Yeah, yeah,
so
yeah.
that's the way kind of due diligence too for me at this point. But what are some of the mistakes that you are seeing people are making when they're evaluating the deals or evaluating the operators or the sponsors?
Yeah, I think one of the mistakes that we talked about, not a mistake, but it's a longer journey, right? Good market or bad market. You
Hmm.
as an investor should know how to make money, and we as an operator should know how to run our business. Otherwise,
Exactly.
if I'm a roofer and if I live in one of the areas that rains 9 months in Seattle, then I won't be able to make money, right? So I need to know how to change that so that I can still make money as a roofer in an area that rains 9 months in a year, right? Um, so definitely stay in touch. Keep know the pulse of the market at all times. In terms of the questions, um, you can definitely ask 50 plus questions to an operator, and you may be able to verify only three. Now, let's say you are able to verify all of it, right? That's still no guarantee of asset performing or not performing.
Hmm.
So the way I've been, I think I've said it a few times, you want to go back to the basics, boring, um, essential, boring real estate asset classes that comes under essential services that you don't see going away, right? If you believe on those asset classes, then you have to go find operators who are looking for assets in the true um, uh, value basis, meaning they're not paying too much, right?
Hmm.
And that is what you have to service to ask. If you if you as an LP, as a limited partner, if you don't know that this deal are they paying too much or too low, that is the biggest risk in my opinion as an LP, right? So you got to know the data, ask for the data if you don't have it, and
Hmm.
figure out why this property was sold for 5 million, $10 million, and today you're buying it for 5 or 6 or 9, whatever the case may be. And go back on the basics and see if the current income or a current expense can really support that, right? So your basic questions still stay the same, but now you got to add one more thing is that ask yourself or ask your operator, are you paying too much or not?
That's true. And then especially if you're partnering with somebody, some operator, sponsor, I want to add a little bit to it, A lot of people they think about this person's track record is good because whatever they put it on the PowerPoint, kind of flashy slides, we
Yeah,
have done this many deals. I think the right question to ask is how much money you have returned to the investors. That's the number one question,
yeah,
meaning how many full cycles you have done. If you
yeah.
haven't returned any money back to the investors and then you just piling up the deals and deals and deals, I don't think that's a good
That's
track
definitely,
record.
yeah, that's definitely an important question for sure.
Yeah, it's a
And
very
again, that's one
important
of the
question.
things where I feel like I could have an awesome track record until 2022, right? And then I can give you the answers like, hey, we have done personally, we have done over $10 million of distributions in last
Mhm.
years, but we stopped distribution in two of the assets in 2022. We didn't lose the deal. None of thing, none of that happened. But we paused the distribution for 1 year. Um, and it's terrible to say because that pause of 1 year it still looks like a super performance on the rest of the other deals where the whole deal was gone. They lost all of the capital, right? Um, and I don't want to go into too much technicality of what it means, but to answer the question, you're absolutely right. I mean, definitely ask those questions. But when the deal that you're investing today, find out what basis they're going in, what is the capital structure, like you and I talked about. You ask really good questions like, what structure are we doing, right? Is it over leverage or not? In you know, and if you're not a technical person, then you definitely want to go back and find out what is the basis that you're going in, and what was the historical basis in that area in the subdivision that people were paying before.
Yeah, no, you said good questions. These are all my questions because I'm in the market and I wanted to know more, and I'm open to partner with more people, and I wanted to know their trajectory. And the other thing I think I pay attention to is I wanted to share with everyone else is as well too. It's not just, don't look at their real estate journey only for the last 5 years, 10 years. First of all, you wanted to know who's are you working with? Are they full-time in real estate? Are they fully
Yeah.
vested? That's the
Yes.
number one question. If it's
Yes.
a part-time job, just like, okay, just like a little bit making money here, that might not be a good fit for you. So
Yeah.
that's the number one question you should have. The other thing is, don't look at, this 5 year, 10-year journey. Go beyond that.
Yeah.
Go back what we were doing before real estate. What then in real estate day one? If not, like I come from the corporate background. So you look at my corporate, how did I perform in my corporate days,
Yeah.
Or I was a professor as well. How did I do then? So the basic, the way you're performing, that won't change. Your basic stays the same. When you transition careers, come to the different career, you're going to work the same way. Whether you come
Basically,
from the
basically
corporate
check the
world.
character, check the character of the
Exactly. So
person before doing that. Yeah.
yeah, if you're missing the deadline or missing the projects in your previous life, you're going to do the same thing over here.
Yeah.
All of a sudden, you won't be a rock star just because you're dealing with bigger money, rolling with, bigger, I would say, the rollers out here.
Yeah.
That's not going to make you a superstar. So those are the things are very important when you're looking at somebody's track record. And again, that's me, my experience, and everybody look at it differently. So I know. I have another question that I wanted to ask you is about the underwriting now. So I think that might have shifted too quite a bit now because given all the scenarios out there. So what is the difference that you're seeing when you're trying to underwrite a deal? What are
Yeah.
your assumptions look like now? It's not going to be overflated numbers now anymore.
Yes, 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 yes. No, and I wish my team members were on this webinar as well. They can answer this in a blink of a second. We are definitely not estimating too much aggressively on the rent growth. We're definitely not estimating the value at perspective of, hey, you want to go and invest $3 million and you're going to raise this much rent. That's not the case. So our capital expenditure reserves are more conservative now. It's more what essentials, deferred maintenance and clean and functional means versus fancy value add, unless the market justifies. And the other thing that we talked about earlier, higher reserves for operating expenses as well as on the capital side. And the expenses, um, we before this webinar, I was telling you, I was reviewing my our company SOP for expense reductions. So when we look at the deal, we know that we can reduce this admin cost and this marketing cost and this. Like for example, we terminated apartments.com throughout our portfolio, and now we are into AI, homegrown CRM that we built. Um, there's our competition, they pay $2,000 per property for a CRM. And if they have 10 properties, looking at $20,000 in expense. We pay $180 for for the whole portfolio, right? And that CRM is built in-house. So even though we have all those tools and skill set in our warehouse, we're still not dropping the expenses, right? Because I want to see, hey, if I keep those expenses as is today, um, I'll, this is really what you look at as a discounted cash flow analysis, meaning if you drop the expenses, if you keep the expenses same and drop the occupancy, um, what's your break even? And can you really realistically get sustain on break even if everything goes bad?
You mentioned AI, and then something come to my mind was I was recently approached by somebody who was looking at as digital twinning. I'm not sure how many people have heard about that. If the digital twinning coming into place, did you hear about that? Digital twinning. So they're gonna be creating the total virtual. I would say the architect, even
Yeah,
if it's a property or
yeah,
something. So
yeah,
that way you'll get to see everything virtually, what went wrong, where everything is, and you can appropriately assign the resources to
Yeah,
get that
yeah,
going. Go ahead.
yeah. It's I have heard those area, but I think it's to a business that I'm in. I have to be really careful in terms of what I implement and what kind of process will break. Well, what we are really doing is we are using AI for all of our marketing efforts, our appointment setting, um, our delinquency calls, our renewal reminders, our work orders confirmation. And those out of that five, three has been implemented so far, two more coming. But those are the true value add that generates revenue. I'm
Got
not
it.
truly interested in, visualizing all my operations and finding out if I change one thing, am I going to make $1 million or not, right? So that we hired that he's doing implementation on Clawbots and programming in marketing agents. It's
Mhm.
going to take another 1 year to kind of mature. But from an operations side, um, all those big five functions that I just talked to you about, the delinquency, renewals, appointment setting, reminders, and renewals. But we're also using a device, an AI model to see water leak in our
Mhm.
properties.
Yeah, that's a good
Uh,
one too.
yeah,
Mhm.
so those are the ones like if you're talking, I'm a tech person. I used to have a tech background and I understand all of those things, but I'm also a businessman. It's like I only want to implement micro level AI to drop my expenses or increase my revenue. Otherwise, I'm not interested.
That's true. I think all the repetitive tasks is gonna
Yeah,
be AI is gonna come in as a bigger player in
yeah,
there. And AI is not coming as a replacement for something. It's just like an extension. It's like a
yeah,
tool,
for
like
sure.
your
For sure.
extension. And if you're looking at that way, and I come from a tech background too, and sorry, I'm really techie
Yeah,
and
yeah,
I
yeah,
love
yeah,
the technology. And
yeah.
I'm not gonna go against it because a lot of people think it's like it's a big fluff. Yeah, it's gonna come down. I don't think it's gonna go anywhere, tell you the truth.
Correct.
And it's gonna change the world the way we're looking at it. We're
Yeah.
stepping in something really big. It's a limitless world where we're stepping into.
Oh, for sure. I mean, I'm
Yeah,
100%. But I think what I'm trying to say is AI has more value to give compared to business owners like us
exactly.
extract,
Right
right?
now.
So there's what I'm trying to say is those business owners who are trying to just revolutionize everything in their business as AI without understanding, they're probably not gonna see the results what they're expecting. Meaning all the administrative tasks, your
Mhm.
accounting, your posting invoices, your reconciliation, your even your audits, right? Your back-end audits, all of that can be done on AI. But if, as an owner operator, if I don't understand exactly how it's going to happen, I'm going to spend more money and I might terminate few people out of my staff and I still don't see the results, right? So it's uh, to answer to address your point, the technology and the AI is definitely going to change a lot of things for good. But as a business owner, if you don't know the ground level details of exactly how things work in your organization, you can implement something wrong and it will cost you tens of thousands of dollars to recover from.
Well, I agree on that. I think that's what the biggest confusion is. And all these companies, they're, spending millions and millions on AI. I think they're just like in competition right now, who's
Yeah,
gonna be ahead of the game. But without having known your basics, what exactly you need and what needs to be amplified, and trying to just do everything and you think
yeah,
everything is gonna get replaced, that's just like a chaos, basically. It's
yeah,
a
yeah.
noise. So
Correct,
it's not
correct.
helping us. So whenever you're looking at any technology, anything new, even the blockchain we're talking about, and the tokenization, it's going to come into picture. A lot of companies are tokenizing real estate these days, big time. And it's going to bring more liquidity. I think that's my next question as well, and then I wanted to ask you about. But I think all these technologies are here to stay for good, and it's going to change the way we are thinking in today's state. But the only problem is, wherever we are, whatever platform we are in, our experiences dictate everything. So we
Yeah,
can see only so much into the future based on our experience. We cannot go
absolutely,
beyond that. So we cannot
absolutely.
fathom what's going to happen next until we get there. Okay.
Correct.
So my next question, liquidity, everybody wants. everything liquid. Everybody's looking for the cash flowing deals in today's date, and that's the biggest question. So how do you think about liquidity at current stage? Should investor be more cautious and hold on to whatever they got, or should be like a little bit more courageous, I would call it, or increase their risk appetite and deploy actively or somewhat actively? What do you think?
Yeah, I can tell you what I'm doing. I'm definitely not touching, going too deep into the stock exchange. I think it's at some point it will correct and will correct very deeply. It'll be a deep
Mm-hmm.
cut. Um, I'm definitely investing more on the stuff that I have been seeing results for the last several years. You know, some of our own projects. So a rule of thumb, if let's say if you're a physician and you have liquidity and you don't know where to invest, or you know where to invest, even though if that's the case, let's say you love Vinky or love me and you want to invest with us, I would still go and tell you it's like, hey, if you can invest in your own business, that can produce more return for you. That's one thing you should do. But if you have different problems, meaning tax situation and dif- um, cost segregation or tax paper tax losses that you have to accumulate, that's different. On third level, like I said, you want to go look at you know asset-based securities like real estate and those kind of assets that you can expand into. Um, those are all three options that are still better than your CD account. Right?
Mm-hmm.
That's not going to produce anything, and practically you're losing, right? Because your inflation is 5% plus minus, and if your CD is giving you 3 or 2, you're losing 3%, right? Um, what we have been doing personally is we've been investing a lot more into income fund that pays out 8% for us, and it's still a first lien uh, loan on real estate that make me personally feel very secure. So we have a very good track record going on over there. Um, that's what we're doing, right? So we definitely not touching the uh, starlights in terms of a slam dunk deal will come through and will make easy money over there. That's not the case. So we're definitely investing in our own projects that we know, um, and trying to stay away from stock exchange at the moment. Market is not as predictable as it was a few years ago.
Yeah, and diversify a little bit between equity and debt both, so you
Absolutely,
have both
diversify
flavor of the
across
house. Yeah.
asset classes, diversify across even
Hmm.
operators, right? Definitely do that.
So how are you approaching the downside protection at this time?
Um, the from a from a stock exchange investor perspective, I mean, we've got some investors who are still invested in the stock exchange. It's hard to protect on the downside unless and until you're a day trader and um, you're buying swaps and you're hedging in some other way.
Hmm.
Um, my only downside protection is today, what am I going in, right?
Hmm.
And if I'm going in with complete understanding and knowing what I can really sustain the risk with the operating partner, that's really my downside protection, right? The or you can also see it this way: if you have $100 to invest and that's all you got, do not invest. But if you have $100 as an extra to invest, you may want to invest, 40-50% of that, maybe not all in this market.
Hmm.
And again, this is coming from an operator who take investors. So, uh, that's the best. That's a, I'm trying to keep it real.
I mean, I think that's the best pitch actually. When you tell people I don't want their money, then they want to give you the money. That's the secret right there.
Hasn't happened to me just yet, but hopefully.
Because that challenge, I'm like, hey, what's wrong with my money? Let me give my money to them.
Correct, 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 correct. Yeah.
Okay, so let's zoom out a little bit over here. Let's look ahead. So, how do you see the next 2 to 3 years playing out for the multifamily? Because this is the asset class you're in. So, I wanted to see through your lens or your glasses, what are you seeing in the future or what your crystal ball has for you?
Look, all of these boring asset classes, they're gonna stay. Um, irrespective of where we are as a national or international economy. It's really a matter of like you're asking is the next 2 3 years. I do see commercial real estate, especially multifamily, going to see a lot more foreclosures coming out because all of those deals that have not performed last year or year before, lenders are now getting tired of managing it on their own. And they can see because lenders are not managers, right? They're not operators. They hire third-party management company, and then they see the same kind of excuses. They're running out of capital of their own to go invest more on the property to be able to run it, right? So 2026, 2027, and maybe some part of 2028 as well, we'll see a lot more um, distressed asset, quote unquote, coming in. And this, like Texas alone, you're looking at, I don't want to quote a wrong number, but it was a very high number of foreclosures coming in Texas alone. And I remember that number almost. I think I had that number in my mind until December. I didn't recheck it again, but the for multifamily, as far as multifamily is concerned, I think that's the opportunity there. If you really want to take a higher risk, um, then you want to go over asset classes that are close to either tech or direct consumers, meaning you want to look at the asset classes that are more catering towards AI or data centers, or
Mm-hmm.
you want to look at towards big retail stores, retail centers. These are more consumer centric. If the inflation and all those things are not in control, right? The first thing they will see is that people will stop going to fancy restaurants or things of nature because that's the first thing that gets cut. So in a big scheme of things, I see real estate assets in a form of onion, right? You keep peeling, and then somewhere in the core, your essential services, your medical, your um, apartment complexes are somewhere in the core, and it's still kind of recession resistant more than other asset classes. So that's how I see it, and I'm going to still continue playing on.
Hmm. Interesting. Yeah, I agree with you on that as well. And I wanted to close with this now. Maybe, I promise this is going to be the last question, until unless you say something else and something else pop into my mind. But but because I think this is what really matters, like especially given the market or uncertainty we are in. And then I think we should be simplifying it. So if you have to simplify it, what's separates the investors who are going to win in the cycle versus the one who are going to struggle? How would you do that?
Yeah, I think definitely all those due diligence questions that you pointed out, and we do have a checklist that we give to our LPs and encourage them to ask. Um, so definitely do that. But at the same time, I know for sure um, this market will turn, right? And if this window is not achieved by investors, I think there'll be an opportunity cost. But at the same time, every person have their own risk appetite. They gotta in today's market. I think if I have a dollar to invest that I can invest, I am investing in this market.
Okay, you said opportunity cost, so that pops up another question. So I lied about the last question.
Sure, no
So I'm
worries.
gonna ask you, is somebody sitting on the sideline, which I see that a lot of people are, they say, I'm waiting for the right time. So what is your
Yeah, yeah,
suggestion there? What are some of the signals that will tell them, hey, this is the right time? I'm not sure if it's gonna
sure.
happen, but what do you think?
See, what I know is that what is not a right time is when your social media and the marketing is all about real estate. Because
Hmm.
now the market is so high, so top, you want to ask yourself, am I at the top of the market? Well, that's not the right time. The right time is when everybody is scared. And then that's where you have to go find out those opportunities for yourself, right? People say that, investing is a passive activity. It's really not too passive, right? You got to go find out and ask those questions and research the data. And you should, and it's not very difficult. It's if you know 4 or 5 big things that gives you an experience, that's all you need to know. So I feel like capital starting on the sideline, um, if they don't invest in 2026, 2027, maybe 2028, that opportunity will go away. And if the
Hmm.
if the national economy goes back on its track, uh, controlling inflation and things of nature, I think those prices will come back up.
Wow. So, like Warren Buffett says, when people are fearful, get greedy. So, this is a time to get greedy, but careful greedy. Be
Yeah,
strategic and be fearful too a little bit, but get greedy. Do
yeah,
not stay on the sidelines. And that's what I'm trying to do, actually. That's my thesis. So, thank you so much, Sid. I really appreciate your time. You've been
absolutely.
awesome. And thanks for sharing so much your market perspective with everyone. And then look at the audience. Everybody's here. It's like we are up at like almost at 90 minutes because
Yeah.
usually our master class is for 90 minutes. So everybody's here because they love whatever you're saying. And thank you so much. So can you share with our audience if somebody wants to connect with you, how they can reach out to you? And everybody, thank you. To recap, distress in multifamily is not just a headline. It can be a risk if you do not understand it, but also if you can understand it, this is the biggest opportunity time right now. So put your right hats on and start looking at the opportunities in a very, very strategic way. And if you ever have any questions, please send me an email, reach out to me, Vinky at loombainvest.com, like you do all the time, and I'm very, very good in responding to your emails, to your questions. And most of you might have my direct number as well. So please feel free to do that. And thanks again, Sid. And what are we seeing in the market right now is not just a challenge. It's a big transition. It's a big opportunity as well. So thanks again, everyone, for being here. Until next time, stay informed, stay intentional, and keep building your wealth in a smart way.